Welcome to The Explainer. We're all about taking complicated business stuff and making it super simple. And today, we're hopping into the cockpit with the aviation services giant AAR Corp. Okay, have you ever looked at a company's financial report and just felt lost? It's like trying to read a secret code, right? All that jargon, all those numbers. Well, forget all that. Today, we're going to make it super simple. We're going to walk through the latest report card from AAR Corp, a huge player in the aviation world. And here it is. This is their official report card for the third quarter of their 2026 fiscal year. And let me tell you, the headline is simple. They absolutely passed with flying colors. But, the real juicy stuff is in the details. So we're going to pull this thing apart and figure out not just what happened, but how they pulled it off. So how good are we talking? Well, the numbers really do speak for themselves. Let's look at the stats that show this company really starting to gain some serious altitude. First up, sales. The company pulled in a whopping $845 million. And to put that into perspective for you, they didn't just meet expectations, they totally smashed them. Analysts were thinking somewhere around $812 million, not even close. But it's not just about the big number. Here's the real kicker. That's a massive 25% jump in sales compared to this exact same time last year. Now that is the kind of growth that makes investors sit up and pay attention, for sure. And look, it's not just about bringing in more cash. Their adjusted earnings per share, which is really just a fancy way of measuring how profitable they are, also shot up by 26%. So what does that tell us? It tells us AGR isn't just selling more stuff, they're getting better at making money while they do it. And the CEO, John Holmes, he basically said it all. He's like, look, this wasn't just a lucky quarter. He sees it as real continuing momentum. And that's all coming from what he calls organic growth, the real core parts of their business. Okay, let's get into the fun part. What are the engines of this growth? I mean, a 25% sales jump, that doesn't just happen by magic. So let's pop the hood and see exactly what parts of the business are firing on all cylinders. All right, this chart pretty much tells the whole story. You can see that while all the parts of their business grew, one of them just went into absolute overdrive. I'm talking about their parts supply segment. It grew by a stunning 45%. I mean, it just left everything else in the dust. That was the star of the show, no question. So let's zoom in on that parts supply engine for a second. The growth in just selling new parts was, it was explosive. Especially to government customers. That part alone shot up 55%. And to top it all off, a company they just bought, ADI, is already doing way better than they even hoped. Okay, so we've said organic growth a few times, and it's a really important idea. All it means is growth a company makes just by doing its thing better, selling more of its own stuff. It's not growth from just going out and buying another company. When you see strong organic growth, that's a huge sign that the business itself is super healthy, and people really want what they're selling. And the CEO also pointed something else out that's pretty smart. Their strategy is really balanced. They have a big presence with both regular commercial airlines and the government. Why does that matter? Well, it makes their business way more stable. If one side slows down for some reason, the other side can pick up the slack. But no flight is perfectly smooth. AAR's report card definitely shows a little bit of turbulence they're dealing with. The key thing here, though, is that they saw it coming, and they've got a plan to navigate right through it. So what's the issue? It's all about a company they just bought called HAECO Americas. Now, this was a big, smart move to boost the repair business, and the good news is bringing that new company into the fold is actually going faster than planned. The flip side? Well, buying companies is expensive and complicated, and for now, it's putting a little squeeze on their profit margins in that one part of the business. But here's the crucial bit, and it comes from their CFO, Dylan Wolin. He's basically telling investors, hey, don't worry. He says the quarter they just finished should be the lowest point for that margin impact. The message is crystal clear. The worst is over, and things are about to get better. All right, so where do they go from here? What's the flight plan look like? After a quarter this strong, what did AAR tell everyone to expect for the rest of the year? One word comes to mind: confidence. Because they had such a great quarter, they've actually raised their predictions for the entire year. They're now telling investors to expect around 19% total sales growth. That's a pretty big leap from what they were saying before, and it's a huge signal that they think this great performance is going to continue. So here's what you need to keep an eye on. First, they're expecting another really strong quarter to finish out the year. Then you've got this big investor day coming up in May in New York, where they're going to lay out their whole long-term vision. And then, later in the year, they're launching a brand new online marketplace, which could be a total game changer for bringing in even more money.
So, let's bring it all home. What's the big takeaway? AAR's latest report card shows a company that is just firing on all cylinders. They've got this super powerful growth engine with their parts supply business, they have a clear-eyed plan for the challenges they face, and they're looking ahead with a ton of confidence. This company isn't just flying, it's soaring. Which leaves us with just one big question.